You're not an analyst, you're not a fund manager or whatnot. You don't have to show your quarterly results to your investors. You are the investor. So if your results by the end of your journey are incredible, great. I mean, you can read lots of theory books, even it's the same with the car, right? You can do the theory thing, but then once you're on the road, you're on the highway, like you go to the United States, in Los Angeles, you have like 8 lanes, or I don't know how many lanes you had there. It's the worst experience of my life, but at least you have experience in, let's say, the field. You're in it, you know what happens. Nobody lets you through, even if you have your blinker on. Nobody lets you through. But with investing, it's the same. Once you invest your money in it, you're going to learn way more. When everything goes up, you don't ask any questions. When it goes down, you start like, whoa, why is this down suddenly 20, 30% or so?
Investors, welcome back to Masters of the Market. Today, I'm incredibly excited to have with me Neil, the Couch Investor. If you have not already checked out his YouTube channel, just after this Masters chat, you got to head over to Neil's channel. Give it a look. He's got a lot of stock insights. And more specifically, when it comes to Neil, he's actually talking all about high growth stocks, but he does have a passion for dividend stocks and dividend investing. So here we are, Masters of the Market chat with Neil, the Couch Investor. Neil, I want to welcome you first and foremost to Masters of the Market, and thank you for being here. I want to get started with the first question, man. The Couch Investor. I want to learn your story, your background, how you got started with investing, and then more specifically here, what's with the name Couch Investor? Where did that come from?
Yeah, so first of all, thank you for having me. It's a pleasure. I've watched actually your channel because of the investing in dividends. Pretty good picks. I think sometimes we overlap in our picks, so that's good. So yeah, Couch Investor. Why did I choose that name? First of all, it's a good conversation starter. Everyone is like, oh, why Couch Investor? But I'll get to that in a bit. I started investing 2016, started investing officially. In high school already, I invested with fake money. We had this economics class. We started a little competition. It's a competition that the biggest bank in Belgium actually does every year. And you start with a virtual portfolio. That was my first exposure. And I was doing quite well for a short period of time. And then I believe conflict broke out in Egypt, I think. And then the whole market tanked because, well, one conflict leads to the market tanking because of oil prices and stuff like that. And then suddenly I was in the top 100. Then I was suddenly out of it just like that. And I was like, pretty interesting how one day I can be in the top and the next day everything is gone and I didn't even do anything wrong. So that was my first exposure of how crazy the markets can be. And then, yeah, years went by. And then 2016, I had a little bit of money, worked through college, stuff like that, and I started investing. So at first I think like everyone back then, maybe even today, you start off pretty safe. We've all read Benjamin Graham's book, we all read Warren Buffett's letters, stuff like that. So we start off with some Coca-Cola, we start off with some dividend, no high growth stocks, even though I did have Microsoft. Now that I think about it, I really regret selling that. But yeah, started off with the traditional type of stocks, then learned more about the markets, how that works out. I mean, the best way to learn is just dip your toes. And yes, you might lose some money at first, but it's much better to lose money at first than when your portfolio is worth way more. Sure. And then yeah, throughout the years, portfolio switched from position to other positions until now I'm pretty certain that most, if not all, the stocks I have currently in the portfolio are going to stay there for quite a while. Going back to the Couch Investor thing is basically because of COVID, because of the lockdowns. I was on my couch every day because of the lockdowns. I was loving investing. And then I started the channel. So I was like, what's a good name for investing channels? Like Couch Potato, maybe Couch Investing. And that's Couch Investor was born. And so, yeah, that's what I've been doing. Well, this channel has been alive since 2020. So yeah, more than 3 years now. And yeah, the portfolio, of course, throughout the pandemic has changed as well, but the core holdings have been the same. The biggest positions are Tesla and Amazon, and then you have Mercado Libre and Meta, and that's basically more than, well, it's 50% of the portfolio already. So there's that. There's another second portfolio, which is dividend, as you said. Which, yeah, I have some controversial picks, but those are high yield stocks right now. It's BTI, Ultra Group, Verizon, Deere and Company, which is John Deere, CVS and Vici. Those are my dividends stocks in a different portfolio. It's basically those positions are 100% allocated. Every time I get a payout, I just buy more shares and I let it ride. So yeah, that's a major overview.
Sure. So a ton of questions now right off the bat. I'm just going to spitfire them your way. First of all, when I first heard of the name Couch Investor, immediately what I thought of, right, was somebody who would be able to really sit down and they don't have to be, looking at the market every 5 seconds or up in arms. They can relax and be on the couch. And then you mentioned that a lot of your picks are for the long term. All in all, how many total positions are in your portfolio, and do you hold any ETFs?
Yeah, so I know a lot of people will say, oh, but he's not really sitting on the couch right now. I know, because studio-wise, bringing a couch where I film is not very feasible currently, but maybe in the future, maybe we'll do that. Who knows? But yeah, I mean, when you hear the name Couch Investor, you probably think about a coffee can investor where you basically buy stuff, put it in a coffee can, and you forget about it for years. But I like investing so much. I like the stock market so much that I don't really mind sitting on the couch and just learning and seeing whatever happens. My portfolio right now, I believe, is 12 to 15 positions in the growth portfolio, and then we have the 6 positions in the dividend one. Yeah,
sure.
But it's let's say it's 15 position. I might forget one, but let's say it's 15 position. But like I said, the majority of it is in the top 5 positions.
Sure. No, I love the take. And honestly, when I first started off investing, I started with ETFs. And then that, in 2020, I actually went on a bit of a shopping spree and I overloaded my portfolio with a ton of stocks, dozens. And since then, I've been trimming. So did you start off with wanting to build a smaller scale portfolio? Or did you have to learn almost through the University of Hard Knocks that, there may be one too many positions in which you can't manage thoroughly, and then you trim down?
Yeah, so yeah, I forgot to answer the ETF. I had VOO in my portfolio before because it was very easy. I mean, you had that, and then you can play around with others, but you know that that ETF should follow the most, let's say, successful and biggest companies out there. But then I didn't mind. I didn't mind adding more position. I didn't mind then just not having an ETF in my portfolio anymore because I like researching the companies. I like following them. It's true that after a while I had one too many positions and I just lost interest in a company. Even if it had gone up even more after that, I don't really care who says that about money. But I mean, I rather remove positions from my portfolio so I can better focus on those than have too many just for the sake of it and then just lose track. Because when everything goes up, you don't ask any questions. When it goes down, you start like, whoa, why is this down suddenly 20-30% or so?
Sure.
So yeah, people will still say, yeah, but you still have 15 positions. Isn't that a lot? Yes, true. But then you have portfolio allocation. I mean, I have 32% of my portfolio in Tesla. So yeah, that's already more than 1/3. So yeah, I mean, sell-side analysts cover what on average 20, 30 stocks or so. They don't really have the time to research so much into each and every position. They just want to get the gist of it and okay, we go up, we go down. This will happen in the coming quarters. And that's about it. I have 15, I have time. Most of them I know pretty well.
Sure. And hopefully in due time, I get my portfolio back down to what I think will be a manageable number, which is where you're at. For me, 12 to 15, I'm looking to get mine down to. But this begets the question here, when it comes to building a portfolio, how did you start? Like, where do you start? How do you begin to look at stocks and know which ones are good for you?
So I'm a big fan of Peter Lynch. I'm like, invest in what you know, invest in what you understand. So I started basically with that, which is why one of the first positions was Coca-Cola. I mean, it's pretty easy. McDonald's was also one of the first ones. And then with the years, I mean, you get to know other businesses, you get to know Amazon a bit more, you get to know Tesla a bit more, which eventually, yes, right now you're getting to the complicated stuff, AI, FSD, robots, stuff like that. But back then it was basically, can they build car in an affordable way? Can they make a big profit? Yes or no? That was basically the gist of it. Of course, there's much more to that story. But the same with other company, Meta, previously Facebook, I mean, they've got billions of users. They just have to monetize better. Yes, there was that period of the metaverse craze and stuff like that. But I mean, 2-3 quarters later, they're back free cash flow printing machine. So it's basically invest in what you understand, what I like, what I use personally. It's true that sometimes I start positions without fully knowing what I'm buying, but I know the basics. The numbers look good. Then it gives me time to allocate more in the future if I like it. So that's basically all of
Sure.
the process.
A rather simple approach, if I may say. I want to go ahead and
The
what I
couch
like to
investor.
say, throw you on the hot seat, but in your case, I guess throw you on the hot couch. I don't know if that works, but I want to take this and throw it over to you. What's the total value right now of your portfolio?
I'm not gonna tell you the real
Ballpark.
number. Yeah, ballpark, it's 6 figures.
So
Yeah,
in knowing that, and you've been investing for how long?
since 2016, so it's gonna be close to 8 years soon.
Okay. And I'm assuming you didn't start with six figures, right? You started with
No,
maybe a few $1,000s.
yes.
Okay. So now here's the interesting question for you, because as we all know, I'm a huge dividend investor. However, your portfolio, even your top holdings, right? They're all growth stocks.
Hmm.
So how would you recommend an investor marry growth and dividend opportunities? And is that something that we all should start off by doing, or would you recommend starting, with just growth stocks or just dividend stocks and then working your way into marrying them?
Yeah, so it really depends how old you are, where you are in your life, in your career, stuff like that. Because to be honest, if you're young, like 18-year-old, or you're fresh out of university, college, whatnot, I mean, unless you're really, really patient and you want to build your dividend paying portfolio for a long, long time, then yes, I mean, go find great companies that always increase their dividend payouts each and every year. You're fine. But if you're young, I still think that growth is the way to go because it has outperformed dividends for I mean, forever, I believe, right now. Of course, you can get burned. If you choose the wrong company, you will be down 60, 70, 80%, as we've seen with a lot of pandemic stocks. But as we have also seen with dividends paying stocks, I mean, realty income was down pretty much, I mean, a lot. CVS, same thing. Companies like Verizon, AT&T, which I own Verizon, I mean, haven't done anything in a decade or more. Great dividend yield, but I mean, performance-wise of the stock, not great. But okay, if you keep reinvesting, your next payout will be bigger and bigger and bigger. Again, it really depends. It really depends. If you're in your late 50s, 60s, you want to retire soon, maybe don't go with the old risky stuff and maybe lose everything. Yeah, dividend, that's where maybe dividends and a mix of a bit of growth can be quite good because the growth can maybe, 2x or so in the next couple of years. In the meantime, you're still collecting your dividend payouts. Me personally, I have the majority in high growth because I get taxed 33% on my dividends. So yeah,
Sure.
it doesn't really always make a lot of sense to buy dividend stocks. And I have no capital gain taxes on my profits. So
So a bit of a different game than those of us who are in the US.
yes, with your Roth IRAs and stuff like that, I mean, you're pretty lucky to have that. And to anyone that does not have it set up yet, maybe do it tomorrow because it's the best thing. It's the best thing.
Sure. What would you say from your experience now over the years, course amassing, right, from just a few $1,000s now to a six-figure portfolio? What would you say are some of the most common mistakes that investors are making, whether they're beginning, their investment journey, or perhaps they're even, trudging the way and they're 2-3 years in?
Many things to say, but I'll just say, don't listen to the noise. There is always noise, whether it's articles for clickbaits or stuff like that. Sometimes, yes, the noise have some reasoning behind it, but most of the time it's very, very short-term thinking. I mean, I can give you a couple of examples from just the past year. Netflix, right? They had 1.5 quarters where they lost a half a subscriber, and suddenly it's the end of Netflix. Next thing you know, it's up three times. Meta is dead, right? They have 3 billion users, but Meta was dead, also up 3x since then. Nvidia at 125. Nobody uses GPUs anymore. Okay, history. I mean, the rest is history. Same thing with Tesla. Same thing. So many examples. Just noise for short-term thinkers. Yes, traders love it because it's volatile. But yeah, don't listen to the noise. And don't be afraid to take profits. I did that mistake at first. I was like, oh, why should I take profits when I'm up XYZ%? And then the gains are gone. So I mean, securing money shouldn't be a crime. Even
Sure.
if you are still a long-term investor, I mean, if a stock goes up 50, 60% in a week, it's usually not the craziest thing to take some money off the table. I mean, the last 3 years, things go up and down pretty fast. So yeah, no shame in taking profits.
Sure. Do you have a specific rule of thumb in that case where if a stock shoots up by X percentage, you're immediately taking profits, or how would you recommend we take those profits?
It depends on the company, I would say. If a company is like extremely undervalued and suddenly it's up 50%, it can still be extremely undervalued. It's just that the market has mispriced it by quite a lot, like the couple of examples I gave before. So yeah, it really depends. When a stock is already, let's say, fairly valued, and suddenly it has some good report comes out or whatever, maybe just that's the weirdest thing is a positive analyst note, as if that changes anything with the company. But suddenly the stock is up 20% on the day. Okay, usually it doesn't make much sense. So yeah, why not? Why not benefit from that little profit-taking day?
What do you think is it, with investors? I don't know. I don't think I can just say investors today, but over time that, makes us so inclined to continue to take on all of this risk, not take the profits. Like, how do we train ourselves, especially for beginner investors? Is there a way to kind of skip over all this time period of needing to trial and error, or how would you recommend we go about that so we can take gains quicker and, kind of skip out on the losses?
I mean, if it were that simple, I think we would all be millionaires very, very fast. But it's human psychology, it's human nature, because when things go up, you're like, oh, maybe it can go up even more. Maybe it can go up even more. Who knows? And then when you take profits and suddenly the next day it's up another 20%, you're going to feel extremely bad and then start making mistakes again and stuff like that. So yeah, it's training to be patient, training not to overreact. I always, if I want to trade and I use my phone, it's probably not a good time. If I'm not on my PC, then maybe I shouldn't be buying or selling anything, because usually when you're on a phone, it's like something you want to do extremely fast. But yeah, eventually you want to maximize the long-term gains, not the short-term profits. Again, it's fine to take profit, but there are some consequences, because the next day it can go up again and again and again. Then you're going to feel bad, but I mean, you still have a position, so you're still making money. That's
Sure.
the thing. We don't have to be greedy. Sometimes we all get caught up in the greed storm, let's call it. Just something we have to work on. I'm still working on that as well. So still making mistakes, make good mistakes, make bad mistakes as well. I mean, I sold Nvidia way too early, made a lot of money, still could have made more, but yeah.
Sure. Is there a way for an investor who, like, let's take an Nvidia, right? Where you take your profits, you walk away. Is there a way then for an investor, do you think, to, practice not having those, I want to say, regrets? Because at the end of the day, right, you made money, you won. And I feel like a lot of us may get stuck in the regret stage and then therefore, risk maybe, I don't know, too much the next go round. Like, what's a sensible way for us to just kind of accept our win and continue to carry on? Or does that come with time as well?
I'll take the Nvidia example. It went up pretty fast. And the thing is, when you sell a position or you take profit or whatnot, there has to be a good reason behind it. What are you going to do with the cash? Are you going to put it in your cash pile and wait for the stock to drop? Or are you going to use that cash because you know that there are other companies out there that are undervalued, so you want to use that, put it there, and then see where you go from there? I, for example, did that not so long ago. I opened a position in PayPal. I mean, I think the company is extremely undervalued. So I took some profits from X company I'm not going to mention because people will go crazy, put it into PayPal. And yeah, PayPal hasn't really moved that much. The other stock went up 20%. Okay, fine. But in my mind, my investment in PayPal should outperform, should make me a lot more than just 20%. Won't happen overnight because they have a lot of work to do internally at PayPal for that to happen. But yeah, again, it's all about patience for those that are investing or putting money, taking profits, whatnot. For the short term, you're going to lose probably more money than you think. For those that are in it for years and years, I'm not talking about 1 year, 2 year, 3 years. I mean, 5, 10, 15, 20 years, depending on how old you are, of course. You have time. You have time. That's the thing. Time is on your, I mean, you're not an analyst. You're not a fund manager or whatnot. You don't have to show your quarterly results to your investors. You are the investor. So if your results by the end of your journey are incredible, great. If you can't handle it, then maybe just buy ETFs. Yeah.
Sure. No, I love the approach, because even though you're, a growth investor, you do take a long-term approach. And I think a lot of investors, especially today, right? I feel like this notion of long-term somehow has become, a year or 2 years. That's now considered long-term. Can you define, for all of us, when you buy a position, whether it's, I don't know how long you held NVIDIA or Tesla, but how long is long for Neil, the couch investor?
So first of all, I understand some of the investors that say, oh, 1 year, 2 years is long, because most of them probably entered the market during the pandemic, especially young retail investors. And I mean, long there is 3-4 quarters, which is a year. That's long already in the pandemic period, because you can go up and down in that period of time. So I can understand, okay, fine. If you want to say that's long during such a period, okay. But during normal times, which since 2019, I feel we didn't really get a year of being normal. But yeah, long is 10 years plus. Even 5 years is already considered long, but long is 10 year plus. Of course, I know myself that during those 10 years, a lot of things can change. But for me to completely sell out a position, it's going to take more than just one bad quarter for me to sell out completely. I sold out of Unity and Roku, for example. Roku purely because I saw a better opportunity right now, even though I still believe in the company. I mean, the stock itself has performed quite well since I sold. And Unity, just too much. Bad management. I mean, it has been too much. So I was like, okay, screw this. It's been over a year now that things aren't really going that well there. So I sold, moved on, we're good. I held Unity for, over 2 years now. So
Sure.
there is that. But yeah, I mean, retail has to learn about patience. I know a lot like crypto as well. So, but in crypto, you can make 100 times your money in a week because you bought some weird coin. But yeah, realistically speaking, you're not going to. Realistically speaking, you will rarely 10x your money. Let's put it that way. Realistically speaking,
Sure.
even I got extremely lucky. I got very lucky with the timing in Tesla. I close to 20x my money in a matter of 2 years. I was like,
Wow.
okay, that usually does not happen.
Sure.
Ever.
That's your one-off, right? Like,
yeah,
that's that moment to shine. And really, I mean, anybody who invested in Tesla, when it was, I don't know, that 5-10 years ago, and who are just holding on. I know I have also Tesla. Tesla's actually one of the few positions I have that's not a dividend paying stock.
mm-hmm.
Neil, I got to ask you a question when it comes to growth stocks. Like, I'm a dividend investor, right? So clearly I'm a little bit more risk adverse. I like to sleep at night, that comfort of knowing that I'm invested, for the long haul. I'm going to be collecting dividends. But man, I hear someone like yourself who's invested in these growth stocks and, from 5 to 6 figures now that you have in your portfolio, and you're doing tremendously well. Should I be, or those of us who are dividend investors, throwing growth stocks into our portfolio? Are we doing it wrong?
First of all, there's no, I'm sounding like an old guru. There's no right or wrong. But no, look, I mean, you sleep well at night because you have the dividend paying companies. I sleep well at night as well because I know that the majority of my money is focused on companies that I know will be around for a long, long time. I mean, I'm down 50% on some positions, but luckily those positions are only 2%, 3% of my portfolio. So fine. If it doesn't work out, it's only 2-3% of that portfolio. If it does work out, okay, cool. But yeah, I do think that young investors should always think about getting some growth in their portfolio, whether it's through an ETF or whether it's through the Magnificent Seven or maybe even lower companies. There are plenty of great companies that are growing faster than your average 12% or so that the market gives you every year. So why not? I'm not saying you should put the majority of your portfolio there, but yeah, why not? Because dividends, it's great, but it's growing pretty slow at first, of course. It's a cash flow system, which is also fine for the future. But yeah, why not? Growth has outperformed, so why not try it?
Now, it was interesting to me in your answer when you first, began to share was you mentioned again, it's all about that long-term approach, right? You said you can sleep at night as well. Although I have this reliability factor, you also have that reliability factor because you're investing in companies for the longer term that or at least feel strongly about will be around for the next, foreseeable decades to come. How do you know what growth companies are going to be less risky for you, like take NVIDIA or take, one of these software companies or, high growth opportunities? How do you know if one of us is a dividend investor, if we want to throw in one or two growth picks, how do we know which ones to pick?
Yeah, it goes back to how I invest. I would say it's buy what you understand, because eventually, I mean, you are investing in that company, so you have to understand what you're buying. You have to understand that growth can come down 30, 40, even 50%, maybe in a month or so. You have to be comfortable in that as well. Sometimes there is a reason. Most of the times, the reasons are macro, so not really company specific. But yeah, I mean, there are plenty of companies that are okay, plenty of software companies, chip making companies, stuff like that. But I don't know if you're interested in e-commerce. There are plenty of good companies as well in that segment. So yeah, choose what you know. If you're going for growth, the same thing with dividend. How do you know? How do you pick your dividend stocks, for example?
I almost feel like with the dividends, right? It's that guarantee factor, and there's no guarantees, of course, in the stock market. So certainly always do your due diligence is really what I hear in your messages. And looking now into the future, you mentioned macros, right? A stock can drop 30-40%. So I want to understand now, I'm a huge fan of macros matter. So I always I'm fascinated by economics, look at the macro picture. Do you use macros a lot in your investment strategy?
So, I mean, plenty of legendary investors have spent close to zero time on macro and have done exceptionally well. I know that in the last 2, 3 years, everybody has been focused on inflation, which again, the Fed should not decide what the market does. That's not why they are here. But somehow we made them God. I don't know why, but yeah. Do I look at inflation, stuff like that? Yeah, of course, I look at it. It it's a good indication of where we're going, even though it's a lagging indicator. But there are better metrics to look at. I mean, we went from inflation is transitory to, oh, inflation is going to be here higher for longer, interest rates higher for longer, stuff like that. So yeah, I tend to listen to my companies and less to Jerome Powell.
Sure. What you mentioned some other indicators that you use that you think are stronger than a lot of these macro factors. Could you mention some of them?
I mean, consumer spending is one, for example. We've seen that Cyber Monday, Black Friday numbers are incredible, despite everything that we've been hearing, right?
Sure.
So yeah, that again, if good management will tell you way more than a Jerome Powell, for example, because he talks in a broader sense how things are looking. Management of certain companies look at their sector where they're operating in. Then you can mix them up. You can listen to Visa, you can listen to Amazon, Shopify, and then you have even more information. So yeah, those are things I look at. Again, macro is great if you want to maybe have a better entry in a company, because in a tough macro environment, yes, certain companies are going to go down because, well, they get impacted by high interest rates and stuff like that. So you always have to, I mean, if the information is free, why not take it? So yeah, if macro information is free, okay, I'll take it. I'll consider it.
Sure. Points in time, only take it with a grain of salt, from what I'm understanding. Now, when it comes to looking into a company, because this is actually fascinating what you shared, right? The company's management team will have far more to offer than a Jerome Powell would. How are you using management teams, or when you look into a company, right? No matter what company it is, whether it was Tesla, Nvidia, Unity, perhaps Unity is even a better example.
Hmm.
How did you come to find Unity, break the company down, and realize at the point that you invested into it that this was going to be your green light, invest into this company? And what kind of factors help you invest into a company? Which ones actually raise a red flag for you?
Yeah. So Unity is a good example because I'm a gamer. I love gaming. So Unity, I, I knew about Unity. I knew about Unreal before I invested in Unity. It's it's interesting because it's a company that is operating in a duopoly. Basically, it's either them or Unreal. So yeah. Then I was like, okay. I mean, mobile gaming is very, very popular. The industry is growing. Total addressable market is huge. I mean, it's in the hundreds of billions of dollars. So okay, makes sense. The momentum was with them. So yeah, I invested. But then, so that's the problem. Bad management can hurt great companies. Good management can make bad companies much better. With Unity, unfortunately, with that CEO, John Riccatello, I believe was the name, ex-EA, which also he didn't do a great job there, which should have been already an orange flag. But he's gone. There's now another CEO at Unity. Yeah, he managed somehow to screw this up. When you operate in a duopoly and you screw it up, then yeah, management is at fault here and nobody else. But yeah, management is a big part of the investment thesis. That's why I've put the majority of the money of the portfolio in those companies at the top: Tesla, Amazon, Mercado Libre, Meta, because I mean, even the trade desk right now with Jeff Green. I listen to what they have to say, lots of podcasts, interviews. I mean, Elon, you can read his tweets every second minute. But yeah, those are leaders where you're listening, like, okay, I wouldn't mind even working for him. And so I'm pretty confident with those positions. And that's again why portfolio allocation is extremely important. Risky picks, keep it 2%, 1% of your portfolio, so that if the company is great, good industry, stuff like that, but there is that risk that management might screw up, then it's only a small hit on your portfolio and you're fine. Then, of course, management, they can always change. And yeah, we'll see what happens with Unity. But right now, yeah, I'm out. So I don't really care anymore.
I'll toss this one out to you. It's a dividend related question. And how a lot of dividend investors who are out there typically tend to chase yield. And I feel like this one might be particularly interesting for you because you have a lot of high yield players
Yes.
in your portfolio. However, the players that you do have in your portfolio, Verizon, British Tobacco, right? These are pretty safe and reliable dividend paying companies. Is it worth chasing yield, or is that something that investors should stray away from? How do we know if the yield is safe? Can you walk us through that process for you as a dividend investor?
Yeah. So again, it's a different scenario right now because of the high interest rates environment. So you're obviously not going to look for those 1-2% yield companies because what's the point? But with regards to Altria, BTI, Verizon, high yield paying companies, it's also high because the stock got crushed. It's a dividend paying company, but still the stock is down a lot. With regards to the tobacco companies, it's because, well, we're going into a more, let's say, healthy society. So they're taking a hit. There are also some regulation stuff going on, even though, I mean, the tobacco lobby is pretty strong. They're also all making switches to vape, and vaping becomes even more popular. Of course, with Ultra, they did a bad acquisition with Juul, didn't work out, but now with Enjoy, I think it will be much better. So yeah, there was a mix there between high yield but pretty solid fundamentals, as we've seen in the latest reports. So there is that. Then there is Verizon, the same story there. Stock performance is abysmal because of all the investment that they've made, huge debt, stuff like that. But then there was that question as well with both Verizon and AT&T: is the dividend safe? Well, in the last 2 quarters, it has been pretty clear that the dividend is very, very safe. So yeah, it's a mix of both, looking for that high yield, because I mean, you're not looking to buy dividend stocks just so you can make 2% each and every year. It just doesn't make any sense. But yeah, I would say maybe sweet spot would be 5% is already high, but 4 or 5% with maybe some upside with the stock price as well. For example, CVS, I think the business should be worth a bit more than what it is today. So I bought it, good yield, not the highest like Verizon and the tobacco company, but good yield. And there might be some stock appreciation as well in the future. So yeah, it's a mix of both, because sometimes high yield can be a red flag, meaning something might not be great at that company, but sometimes you have to look a bit deeper and you see that, okay, stock went down, company is still generating a lot of free cash flow, dividend should be safe. So we're good to go. That's my view, of course. Might be completely wrong, but right now
Sure.
I think it's a good one.
And you're currently dripping the dividends, reinvesting them right back into the stocks
Yes.
themselves, right? So when you're dividend investing, right, because you have on the growth side, you are down pat for, it sounds like, the longer term, and you're looking into, what I want to say are pretty, well-built companies, great management teams. And likewise with your dividend stocks, right, for the long haul, are you padding up your portfolio with the dividend stocks for the safety?
Yeah, so it goes back to how I started investing, because back then, I mean, Coca-Cola was paying a dividend as well. So I always had a good relationship with the dividend realm. But yeah, now I really started because of the opportunity of getting a higher yield than usual, because of the scenarios between all of those companies. Because maybe, I don't know, 2 or 3 years ago, I would have looked at these companies, yield would probably have been much lower, and I would have not bought those companies. But right now, because of the opportunity, I pulled the trigger. Obviously, it's much smaller than the growth portfolio, but again, like you said, like many dividend investors, you do this because of the cash flow. You know that every year your payout is going to get bigger and bigger, or I mean, we hope that every year our payouts will be bigger and bigger, because when the dividend will increase, we own more shares right now because we reinvested our dividends, and so on and so forth. So yeah, that was basically the decision. Again, can be completely wrong, and in a year or two they won't be able to pay a dividend anymore. But I doubt that will be the scenario here.
Sure. So let's say in the coming months, right, that Jerome Powell's dreams here of 2% inflation come much sooner than expected. Interest rates start to make their way back down, tying in our macros. How, if at all, will you change your investment strategy? Will dividend stocks still be a big, aspect of your portfolio for the long term? Or are you going to shift out of them and go back into, heavier growth opportunities? What would you say in the environment, coming up perhaps at the end of 2024, where we're expecting inflation to really hit that 2% goal and interest rates to start coming back down? How does that change the game for you?
To be honest, it does not change anything, because right now I have positioned the portfolio to be as optimal as possible in case that, well, not in case, I assume that will happen. I still think that in the first half of 2024 we might get a rate cut. So, and again, the rate cut will happen, but beforehand the market will already go up because of that signal that probably we're going to get from the Fed. So yeah, no, I have no, there's no I would say this, there's no desire from me to start, I mean, deleting all my position in the dividend paying portfolio. It's there, it's going to stay there. I know that growth will again outperform everything else. I mean, even right now, a lot of growth stocks are outperforming dividends, but when rates are lower, usually growth stocks outperform even more. So now I've positioned my portfolio to do just that. I mean, rates will come down, inflation will come down. These companies should become much stronger as well. So stock should reflect that. Whether or not it will happen directly, I don't know, because there's also elections in the United States next year. So that will be interesting. Yeah, nothing really should change. Again, you have to position your portfolio so that in bad times it is stable-ish, and in good times it can go up with the whole market and outperform.
So it sounds like you have a strategy that's been set into stone, and it's from what I think is kind of built
Set
from
into
your.
sand, let's say.
I like it better. Set into sand. The strategy then that you have now, looking ahead, or even when we look back, this strategy came out of trial and error, right?
Yeah.
And what should we as investors do when we start investing? I'm curious to know your take. Should we first read a bunch of books and study as much as we can, and then go growth, go dividends? Or is it the trial and error approach that you think is necessary for one to actually develop the strategy that's best for them?
Yeah. So it's, since investing, we're talking about your money. We're talking about basically, I mean, your future. If you want to retire earlier, you have to make the right decisions. We're not talking about, oh, I want to start painting or go fishing or whatnot. Because hey, you try painting, doesn't work. Fine. What did you lose? Maybe some time. It's all about the experience, let's say.
Sure.
With investing, you screw up, you lose money. To get that money back, you have to work more. I mean, it's again, it's time. Time equals money. So yeah, I would say reading is definitely going to be number one. Lots of great books, lots of great research papers. I mean, great accounts on X as well, sharing a lot of knowledge that usually you wouldn't get before. People in the industry that share a lot more than what you used to get a couple of years ago. And then I would say yes, play a bit with a little bit of money you can afford to lose. If it's $100, $200, $1,000, doesn't matter, because that's something that books cannot teach you. The moment you spend that money, suddenly your brain is like, ooh, maybe now let's chill out a bit. Because theory is great. I mean, you can read lots of theory books. Even it's the same with the car, right? You can do the theory thing, but then once you're on the road, you're on the highway, like you go to the United States, in Los Angeles, you have like 8 lanes, or I don't know how many lanes you had there. It's the worst experience of my life. But at least you have experience in, let's say, the field. You're in it. You know what happens. Nobody lets you through, even if you have your blinker on. Nobody lets you
Sure.
through. But with investing, it's the same. Once you invest your money in it, you're going to learn way more, because you're like, okay, my money is in that. I better not lose it. You're probably going to lose it at first, but at least those lessons, you pay for your lessons. Basically that.
Sure. It's like tuition bill, University of Hard Knocks tuition.
Yeah. Better university than any real one, but yeah.
Yeah. All through experience. I'm curious to know from your perspective, because you started quite young and you've been doing very well. Are there steps that we should take before we even invest? Right? Because okay, so reading books, gaining the knowledge, but ultimately, then actually throwing money into the market. Before we get invested, I'm curious from your standpoint, should we be doing anything else? Like, how do we dot our I's, cross our T's before we start investing?
Know, I would say, know why you're investing. Have a plan for your investments, your portfolio, which type of companies you want to buy, you want to look at, should I say. Talk with people that have invested before. I mean, when I started 2016, I didn't even consider going on YouTube to listen to people talk. And now I'm the guy talking. So yeah, now you have so many possibilities, so many options out there before you even start putting $1 in your portfolio. So yeah, I would definitely write down on a piece of paper what your plan is. Why are you doing this? Is it to get rich quick? Forget about it. I mean, you can do whatever you want with your money, but if you think you're going to get rich in a couple of months or a year, you're probably doing it wrong. And then yeah, just do it.
Sure.
Nike slogan.
This begs the question I want to ask. What is your why? And if it has your why changed over time?
No, my why is still the same. It's to be able to fully enjoy life way earlier than what it would have been. I believe if you do not invest, then you will probably retire like everyone else at, I don't know, 65 or something like that. Some people are unlucky and aren't even here at 65. Some people are lucky, they're here until they're 100. But life is getting more expensive, whether we like it or not. Hopefully things will get less expensive with all the technology and artificial intelligence, which should lead to deflation. But depending on which government runs the business, we'll see what happens. But yeah, it's really to be dependent on myself and not on on my pension or whatnot, to be able to retire comfortably, to be able to have fun with the family, spend time with friends and family when I'm older, but younger than what I should have been to be able to retire. So yeah, the why has always been the same.
Sure. Investing your way truly to financial freedom. And it sounds like you're well on your way there. I want to ask you one last
Hopefully.
question. Neil, it's actually one of my favorite questions I ask every investor who joins me here. And it's an exciting one in particular for me to ask you because you're not focused so much so on dividend stocks. You got a lot of growth stocks in your portfolio. Now, I have the honor and privilege every single Masters of the Market chat to gift every guest virtually with a fake $10,000 to invest in any stock that you'd like to invest it into for the long term. So I'd love to know which stock, if I gave you $10,000, would you throw it into and hold on to for the long run?
It doesn't have to be a dividend one, or should it?
No, it doesn't have to be a
No.
dividend stock. It could be growth. It could be dividend, whichever one you feel is the $10,000 pick, perhaps for financial freedom.
Um, hmm. I mean, right now, probably I still believe that's right now, but you're saying for the long term. So, because if it's shorter term, I mean, for the next 2 years or so, I think PayPal is a crazy risk reward right now. But if we're talking about 10,000 long term, I have to go with my number one pick, which is Tesla. I still think it's going to be the largest company on the planet, not just because they sell cars, but because all the other businesses that they have inside that company, whether it's energy, AI, full self-driving, you name it. I think even it's crazy to think because it's already a $730 billion company right now. Um, so yeah, but God forbid if something happens to Elon, and then maybe something might change. But so long as he's alive and hopefully still a long, long time, I think it's the best bet. I mean,
We got
I have 32% of my portfolio in that, so I believe it's the best bet.
all in here with the 10K on Tesla for the longer term, PayPal for the shorter term. Neil, the couch investor. Neil, I want to say thank you again for joining me on Masters of the Market. Truly, it's been an honor to learn about some of the growth stocks in your portfolio, how you've married growth in dividend stocks together. And investors, you got to go check out Neil's channel, the Couch Investor, right after this chat. Now, join me in thanking Neil for joining us here, Masters of the Market. Investors, until the next one, we will see you all there.